Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, welcome back. So the market's absolutely steady, 68, 70 odd points on the Nifty. But we're talking commodities and especially what's likely to happen with rubber prices. Kerala is, actually the largest rubber growing state in the country. And with floods, is the crop likely to get affected and are prices likely to move up? Manisha is here and she's speaking with an expert on the subject. Manisha, morning.
Morning, and thank you so much for that, Prashant. Well, yes, as the water recedes and the life comes back to near normal in Kerala, we have seen assessment of losses come in for many of those commodities. Overall, the latest reports suggest that when you look at tea, coffee, cardamom, rubber, the losses are estimated at the tune of 600 crores. If you look at tea alone, we are looking at 1 to 1.2 billion rupees of losses coming in just for that commodity. The estimates are that 200 kgs per hectare is what the losses could be when you look at tea as a crop there. But rubber, of course, is in the storm of the eye of the storm rather. We have seen the prices continue to gain up from 117 rupees per kg in the month of March. We have seen prices gain up all the way to 132 rupees per kg plus kind of levels as well in this week itself. The estimates are that you might be looking at a decline of 13.5% to 6 lakh tons of a crop this time around. The rubber tapping has been suspended, and that may be a case for an extended period of time is what we hear from the rubber growers or rubber planters in Kerala. The important thing also is that with the rubber prices and with the kind of losses that the industry or the farming sector was making, there was an imposition of import duty of 25% on rubber imports. The global rubber prices have been anyways under pressure because we are looking at the global rubber output increase by 6.1% to 14.2 million tons, while the demand is estimated to increase only by 2.8% to 13.3 million tons. So we are looking at a surplus in the global markets, but the Indian markets, with the kind of losses and with the kind of crop damages that we are witnessing, there perhaps would be a more requirement to import here. But let's go across to Mr. G.P. Goyal, who's President, Cochin Rubber Merchant Association. He joins us on a phone line. Mr. Goyal, hi, thank you so much for joining us. First of all, what really is the state in Kerala right now? What is the latest on tapping there, and what kind of losses are you guys estimating?
Oh, Madam, tapping is completely stopped for last 15-20 days. The workers which were available from Bihar and Orissa, they already left Kerala, and production has drastically come down.
Mr. Goyal, the numbers show that we might be looking at 13.5% of an output decline this time around. What numbers are you?
Declining more than 15%, madam.
Mr. Goyal, also what is your sense on the prices right now? Because we have seen quite an upsurge in the Indian markets. How are you estimating prices going?
Prices may not go up much because import is taking place, and from Agartala and Tripura we are getting, North India they are getting material from there.
Mr. Goyal, what is the sense on imports? Because
imports is there. Import even prices are not very high, and still they are importing, and availability is there from Vietnam and all. They are importing in bulk. And in Kerala, I think production what we were expecting 6,25,000 tons this year, I think it may come down to around 5 lakh tons. That is what we are expecting now.
Sure. Mr. Goyal, if we look at the last quarter, almost 40% of natural rubber demand was met by imports. Do you see that number increasing?
No, number that may not increase more than 40%, but availability will be there. And Kerala loses its importance because the production is less and workers are not available. Tapping is closed, and so many plantations, they have lost the trees. Only uprooted, so many trees are uprooted.
So, Mr. Goyal, just coming back to prices yet again, 132 rupees per kg is what we are working with right now.
Now it is running 132. It may go up to 140. More than that, more than 140.
All right, Mr. Goyal, we'll let you go at that. Thank you so much, sir, for joining us. So that really is the view coming in. Many of the trees have been uprooted. There has been no rubber tapping for 15-20 days, and that may be the case for a longer time because there are no workers and there are no trees to begin with. And from 132 current, 140 rupees per kg is his estimate on the prices going forward.
Okay, all right, Manisha, thanks very much for that. So I think we need to keep an eye out on that in terms of rubber prices. Currently at 132 rupees and could possibly rise to 140, but imports plus material coming in from the north is probably sufficing a little bit at this point in time. But we do have Ashwini Gujral joining in to talk about the technicals of the market. Ashwini, over to you then. What are you recommending? One on the Nifty as well as two on specific stocks?
See, the market is consolidated extremely well above 11,500, 520. So my sense is that today, since large banks like HDFC Bank, Yes Bank, etc., Kotak, all the private banks are also chipping in. It would be a good time to get long on Nifty as well as Bank Nifty. Hardly, one sector is in the negative. So I would think we are positioned for a second half rally as well. Now your trailing stop can be easily 11,500. And my sense is that the bears are not getting traction at all. They haven't been able to, bring the market down hardly by 10 points. So having said that, HDFC, the housing finance company, that's been going down for 4 or 5 days. And today it's reversing. So this is a buy with a stop of 1895, target of 1940. Pidilite Industries, a buy with a stop of 1140, target of 1180. And Piramal Enterprise, that's a buy with a stop of 2720, target of 2800. Today I can notice paints, Pidilite, housing construction material. So that's, the positive coming out of, this Kerala and the rebuilding, etc. So those are good areas to look at even for the day.
Thanks very much. Appreciate you joining in, Ashwini. Short conversation. We speak again in about an hour.
Well, let's get talking on the fundamentals of the market. We have Mukul Kuchar, who's the head of institutional sales at Investec Capital Services, joining in to discuss the market and the trends of what we're seeing right now. Mukul, hi. Thanks very much for joining in. Well, 11,500 for the Nifty. What are you buying and what are you selling?
So, there are a few trends that we've been talking about for some time now, and I don't think anything has changed as far as those trends go. One is we've been talking about rupee depreciation since the beginning of the year. Now, all the factors that we were worried about that would lead to this depreciation are still in place. So this is something that, we still sort of are watchful of, and any portfolio construction we do should take this into account going forward. The second trend that we've been speaking about is private financials, and, that is a space where we see good earnings momentum, and we are still sort of constructive on that. And the third leg of the theme that we speak about is discretionary consumption. And once again, given where demographics of the country stand and where growth comes in, we are still constructive on that. So these are the three themes that we think will underpin Indian markets. Overall, we have the elections in the corner, but we'll see how dynamics play closer to the elections. But more or less, these three themes are what we are sort of talking to clients about today.
Mm-hmm. Mukul, hi, morning. Earnings are picking up, and that's a great thing.
Hey, Prashant.
Macros are much better when, as compared to when rupee was at these levels in 2013. I mean, one gets all that. But the overall picture, the global risk story is souring a little bit. I mean, the MSCI Emerging Market Index, for example, is down some 24% from its life highs. Nifty in dollar terms is down about 7% from its life high. So we are outperforming it by a very large margin. Can it continue, is my question.
So Prashant, this is a very good question. I mean, if you look at why this outperformance is happening in India, it's despite of the macro. It's because of the structure of the market. Our market actually that way is very diverse. It's a good market. We have a good mix of exporters. We have private financials, which is a theme that runs independent of the domestic economy. If you actually look at where we should have an impact of the overall EM breakdown, we are having an impact. Rupee is actually a fundamentally weak currency for the last 1 year or so. We have depreciation close to 9 or 10%, and there we are not sort of standing out. It's because of the export section of the market, because of the strong consumption theme, which is not really impacted by near-term macroeconomics, because of the strong private financials, which is gaining market share at the cost of PSU banks. That's why the market is holding up. It's not because the macro is not getting impacted.
What about corporate lenders, private corporate lenders, for example, the likes of Axis, Yes Bank, all of these? Are you preferring them to, say, NBFCs as well as, say, PSU banks simply because of the kind of increase that or incremental run that we've seen in these?
This is actually, a very good question because, I honestly don't break down the financial market with corporate and retail. I rather break it down the way you said it, which is banks versus NBFCs. And within banks, you have PSUs versus private. Now, when you look at, banks versus NBFCs, I'm definitely more positive the banks because, if you just overlay what I laid down on the macro side, which is a weaker rupee is inflationary. And you'll see that WPI has already picked up over the last few months. CPI normally follows with a lag. So we see inflation picking up in the country. I mean, even though oil has stabilized, once we depreciate 10% against the dollar, oil in rupee term goes up. So we see inflation being driven by fuel actually coming through in the economy. That will impact cost of funding for NBFCs. So this is not a good environment to stay in NBFCs, especially ones where cost of funding can be a problem. Banks are a better deal. Banks also have, not only a stable cost of funding, they have customers that they can cross-sell into. So, per se, we prefer banks over NBFCs. Now, within the banks, it's more private versus PSUs rather than corporate versus retail. And there's a fine line there. So all of these, so what we call as corporate banks, which is, let's take the example of ICICI Bank, now has a bigger retail book. So, I like ICICI Bank because of its valuation, because of its retail businesses, honestly, which is mutual fund, life insurance, general insurance, because of its very strong CASA, because of its very large client base. And in that perspective, the valuation is very cheap. So it's more a preference for private banks. In the context of the valuation, we like HDFC Bank, ICICI Bank, Yes Bank, RBL Bank, DCB Bank. Among the regionals, we like City Union and Karur Vysya.
Mukul,
avoiding NBFCs for now.
Okay, all right. I wanted to talk about, you track insurance, the business very closely, and wanted to talk to you about the new government program and the impact that may have on the listed universe, if any. But we'll have to postpone that for another time. Thanks very much for joining us, and hope to have you back on the show soon again. Thanks indeed. Okay, that's Mukul Kochar from Investec with a perspective, brief perspective on markets. So the market's looking pretty strong, 74 points higher as far as the Nifty goes. Let's put up the stock of Zensar Tech, and it's basically at a new high, all-time high. So 1434 was the last all-time high. With today's 6.5% pop, that takes us to 1461. So it's marching on, and it's been a pretty strong year as well, I think. For the year, that is year to date, the stock is up 64%. Well, that's quite something. We have the management of Zensar Tech joining us. Sandeep Kishore, Managing Director and CEO at the company, is with us here. Sandeep, thanks very much. Great to have you with us here. Thanks.
Thank you for having.
When you look at a 64% gain in the stock, I mean, how do you correlate that to the business, which is to the business environment, the business momentum really at Zensar?
So, Prashant, we've talked about this earlier as well, that we are focused into digital technology, and we're executing quite well. We announced our Q1 results, and 43% of our business now is digital. That part of the business has grown 40% year on year. It grew about 12.8% sequentially. So we are executing quite well to the strategy that we had articulated, that we are a return on digital platform plus services company, rather than just a pure play services company. And we are winning, quite well. We won over $500 million worth of new deals in the last 12, 15 months, and we are in the execute phase for that. So overall, it feels quite good.
Are the margins you make on this 43% of the business, which is digital, higher than the rest of the business?
Currently, it's in the same level because digital programs are not at scale yet. They are between, $5, $10, $15 million TCV range. The traditional programs are between $15 to $100 million TCV range. And there's a lot of upfront investments you have to do on site, which is closer to the customer. And that does take a little bit of an investment upfront. As you get into full-scale implementation and large-scale program, I do believe that the margin in digital will be higher than the traditional margin.
No, globally, is that the case, that margins on digital business are higher and that eventually you'll get there? Is that the... I mean, my question is, why should we be excited about 43% of the business for a company coming from digital as opposed to traditional, plain vanilla, bread and butter IT services? I mean,
so as I said earlier, it is a platform plus services play. It's no longer a pure play services play. So if it is platform, the margins on the platform that you build, at Zensar we build Return on Digital, which is our own homegrown platform, which about 3 quarters ago we launched it to our customers. The margins on that are significantly higher than the traditional services margin. And as that starts to scale, you will see a margin play come in as well.
Okay. There are analysts who are expecting, say, a dollar revenue growth of 18.9%, inclusive of all of your acquisitions in FY19. Are you on track to, say, achieve so much?
So we don't give any forward guidance. What I've said earlier is we will for sure beat NASSCOM guidance. We've done quite well. 18.1% is what we delivered growth last quarter on dollar term here. So we are doing quite well in executing to the strategy that we have articulated.
Okay, what about organic growth? Say X of all of your acquisitions, you're just talking about your base business. How is that doing currently?
So Q1, Ekta, we did about 14.5% organic, core organic business year on year on constant currency, about 3% sequential, core organic, also, you know, on the baseline of the business itself. So even the core organic business for us is actually doing quite well, and we're very happy with the way we are executing it.
So how much do you think you can, I know you can't give guidance per se, but are you going to be, say, in double-digit growth? If you're talking about double-digit, is it going to be mid-teens? Is it going to be early teens? How is it looking for you?
No guidance, but certainly double-digit. Absolutely, yes.
Okay. You know, the other thing that I wanted to ask you is that you've concluded 4 acquisitions, I think, in the past 3 years. You're very active within that space, and I think majority of it is focused on the digital space. What more are we expecting in terms of acquisitions? How much cash do you have on books as well?
So we are an acquisitive company. You know, in the new phase of Zensar, when we started the transformation about 2.5 years ago, we said that we are going to be focused on tuck-in acquisitions, which are between $25 and $75 million enterprise value. We've concluded 4 in the last 21, 22 months, and we are continuously looking. We are still an acquisitive company. We have raised some debt as well, and the acquisitions are being funded through the internal accruals as well as debt. And we have, you know, $70+ million of cash available with us to do more acquisitions as well.
Has the IMS business turned profitable?
Yes, it has. Absolutely, yes. We actually now call it CIS, which is Cloud and Infrastructure Services.
Okay.
And we've done quite well last quarter, actually, 13% sequential growth on the core CIS business. The customers are moving to cloud, and that provides a huge opportunity in the next generation of cloud infrastructure services. It's about cloud orchestration, provisioning, onboarding, security, a lot of modernization of the application stack itself, plus the AI-led automation tool that we have built, which we call Vinci, is doing quite well into the new next generation of customer data center environment, security environment, storage environment here. So it helps our customers be far more effective when they launch their product into the marketplace.
Okay. All right, Sandeep, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is Zensar. In fact, the stock is up around 6.3%. Fresh high for that stock. Zensar currently at around 1,460. Well, let's get to a CNBC TV18 exclusive then. CNBC TV18 first broke the story of Samara buying Aditya Birla Group's retail arm More. Now the deal is close to announcement. Nisha Podar, who broke the story initially, joins in with all the exact details. Nisha, over to you.
That's right. It's a big transaction in the retail space, and we've been tracking it. In fact, we broke the story in March this year when Samara Capital had just initiated talks to buy out More. Now, Amazon has come into the picture, which makes this transaction even larger. 4,200 crore rupees is what sources tell us is going to be the total deal size for buying out 100% of Aditya Birla Group's closely held retail arm More by Samara Capital, which will be backed by Amazon. We do gather that Amazon was in talks with Samara Capital for a while, but they had to come up with a structure which will be in line with the FDI regulations in the retail segment in India, and therefore they have come up with the SPV structure by way of which Amazon is likely to buy out first 33% and then 49% in this particular asset and back Samara Capital in making this particular transaction. We do gather Samara is also going through an AIF format. The deal is in the final stages currently and likely to be announced very soon, in a matter of a couple of weeks, is what we gather from sources with direct knowledge. Now, this will help Aditya Birla Group in two ways. First, the stop loss in the loss-making more, and also, on the other hand, recover a large part of the investments that have already been made in more.
Nisha, thank you very much. So we've got the market, which is up about 70 points, looking good. Just want to highlight a couple of stocks which are moving on large volumes. I mean, if you can start with Skipper, I think there's a 14% gain. It's up at 138 rupees. HCC, 14 odd rupees plus. Large volumes, 10% higher. There is Petronet, very actively traded. I think that is seeing about a 4-5% gain. There is Idea, which is up strongly. I mean, but of course, coming off extremely beaten levels, 5.5 higher. And then there is Cadila Healthcare, which is looking up as well. With that short commentary on markets, I'm going to wrap up this edition of Trading Hour. Thanks very much for staying with us. Halftime report will take the action forward.